All right, let's dive right into this explainer. It's June 8th, 2026, and looking at the digital asset landscape today is honestly like watching a high-stakes, vibrant anime clash. We've got this dynamic tug-of-war playing out between extreme retail panic, relentless macroeconomic pressures, and some of the absolute most aggressive institutional accumulation we have ever seen. Today, we're going to cut through all that noise and figure out exactly what is driving this massive market disconnect. So check this out. The crypto fear and greed index just absolutely slammed down to an 8 out of 100. That drops us straight into the extreme panic zone. Just yesterday, this thing was sitting at a 12. And since this index blends volatility, trading volume, and social sentiment, an 8 means retail investors are completely terrified. People are rushing for the exits, convinced the floor is about to fall out. But here's where we hit this massive paradox. I mean, if the market is in extreme panic, right, and everyone is supposedly selling, why in the world did we wake up to Bitcoin prices actually surging? It's a huge disconnect. We're looking at a direct clash between what retail investors are feeling, what the institutions are doing, and what the charts are actually printing.
We're looking at a super stark divergence here. On one side, institutional spot ETFs are just bleeding out. We're talking 14 consecutive days of net outflows, with over $325 million withdrawn today alone. Over the last month, that's billions out the door. But then, right in the face of all that exiting capital, Bitcoin violently bounces off its year-to-date lows of roughly $60,030, surging right back past $63K. How do we get prices pushing higher when the smart money is supposedly selling?
Well, the answer is leverage. The real culprit for this price surge, it isn't some organic wave of fundamental demand. No, it's a violently cascading short squeeze. In just 24 hours, we saw over $602 million in total network liquidations. And of that, about $459 million came directly from short positions, people betting the price would drop, being forcefully closed out by the exchanges. It triggers this massive automated buying spree to cover the bets.
And this perfectly illustrates the illusion of recovery we're seeing right now. The market is absolutely punishing bears who got a little too greedy, sure, but the underlying momentum, it's still incredibly fragile. This is a technically driven move. It's a feedback loop of forced buying, not a wave of new investors deciding today is the day to buy. If that forced buying suddenly dries up, this price surge could just vanish.
Moving on to Section 1, the institutional anchor. BMNR's mega treasury, $9.03 billion. While retail traders are panicking, the heavy hitters are quietly accumulating. Bitmine Immersion Technologies, or BMNR, just announced a milestone that officially makes them the world's leading Ethereum treasury. They now control a staggering 5.54 million Ethereum. To put that scale into perspective, that's nearly 4.6% of the entire global supply, and they grabbed this in just 11 months.
But the really crucial detail here, they aren't just letting it sit idle. BNMR is actively staking 85% of that Ethereum position. That is roughly 4.7 million coins actively put to work securing the network. And by doing this, management forecasts they're generating an estimated $230 to $270 million in annualized revenue. They're treating ETH like a high-yield, foundational asset, not just a token to flip.
And they've got serious firepower behind them. With backers like Cathie Wood, Founders Fund, and Tom Lee, they are operating on a massive macro thesis. They see things like agentic AI and Wall Street's shift toward asset tokenization as undeniable long-term tailwinds. Basically, they're betting billions that as AI systems become more autonomous, the world is going to demand a highly secure, neutral blockchain infrastructure. And they clearly think Ethereum is it.
Let's shift gears to Section 2, the macro ceiling, jobs data, and geopolitics.
So the immediate hurdle for the market right now is liquidity. We just got hit with a surprisingly strong U.S. jobs report. With non-farm payrolls hitting 172,000, expectations for a Federal Reserve rate hike this year spiked dramatically, jumping from 50% to over 70%. Higher rates mean a stronger dollar and tighter liquidity, which historically puts a really heavy ceiling on risk-on assets like crypto.
And taking an impartial look at the geopolitical board, it's pretty tense out there, driving huge volatility. Headlines about missile exchanges between Israel and Iran are creating these sudden risk-off environments where capital just runs to safety. But then on the flip side, any optimism around a potential US-Iran deal acts as this massive risk-on catalyst. The market is incredibly sensitive right now, just whipping back and forth with every single breaking news alert.
This brings us to some wild, micro-level chaos. We're seeing a massive split personality in the market right now. On one hand, you have that institutional caution driving 14 straight days of ETF selling. On the other hand, the retail traders who are still in the game, they aren't seeking safety. They're diving headfirst into extreme speculative rotation, pumping up low and mid-cap tokens.
Which leads us to Section 3, the casino returns, extreme speculative volatility.
While the big players are stalling, individual altcoins are experiencing some absolutely face-melting volatility. Look at these numbers. It's like a brightly colored comic spread of wild gains and brutal losses. Audiera, or Beat, literally doubled in price, up 101%, just riding an NFT sector rebound. Meanwhile, Home crashed almost 39% because a massive 750 million token unlock suddenly hit the market. An unlock means restricted tokens are dumped into the circulating supply, and it just crushed the price.
And if you want a stark lesson in how fast fundamentals can shatter, just look at Zcash. It's attempting a tiny bounce today, but that's after a devastating 50% drop last week. Why? A critical flaw was exposed in their Orchard privacy pool that actually allowed the creation of undetectable counterfeit coins. Because it's a privacy coin, you can't even mathematically prove if it was exploited before the patch. That single bug just absolutely wrecked confidence in the asset's core promise.
Finally, Section 4, Capitulation Watch. Navigating the choppy grind.
So tying all these conflicting signals together, how do we navigate this? You've got to watch these 3 specific technical levels like a hawk. First, keep a super close eye on the $60,000 Bitcoin support. That's your psychological floor. Second, watch the daily closes. If we close a day below $61,500, that could easily open a trapdoor down toward $53K. But on the upside, if this short squeeze is going to become a real trend, the bulls absolutely need to reclaim and hold that $65,380 resistance.
Even with all this day-to-day anxiety and the choppy action, it is so important to zoom out. BMNR's management put it perfectly, saying, quote, "The regulatory and technology shifts now happening in crypto are like the US moving off the gold standard in 1971. These institutional whales, they aren't staring at 15-minute charts. They view this exact moment, right in the middle of all the panic, as a generational paradigm shift for global finance."
So, I'm going to leave you with this provocative thought to consider as you navigate the market today. With the panic index flashing red, massive short squeezes firing off, and all this geopolitical noise, are you focusing on the fundamental floor being built by these institutional titans, or are you just getting swept up in the daily casino? Take a breath, rely on the data we just walked through, and stay sharp out there. Thanks for joining me on this explainer, and I'll catch you on the next one.